Everyone talks about the Beckham Law as if it were the only reason founders moved to Spain, because flat personal tax rates make good headlines. But while people argue about employee income tax, Spain quietly rewrote the rules for startups themselves. Not just for founders as individuals, but for the company, for early employees, and especially for investors. And this is where the real long-term money often sits. My name is Hector, and I work with founders and investors who want to understand Spain's tax incentives as a system, not as isolated tricks, because the startup law was never meant to be a lifestyle perk. It was meant to change how companies are born, funded, and grown in Spain. The problem is that most people here lay to startups and think it is just a rebrand of the Beckham Law for tech people, when in reality it targets completely different pain points. It is not about your salary. It is about survival in the early years, access to capital, and not suffocating innovation with taxes before the business has a chance to breathe. Stay until the end, because the biggest benefit of the startup law has nothing to do with founders' income and everything to do with how risk is treated for companies and investors. The Spanish startup law, officially known as the Startup Law, was designed to make Spain competitive with other European ecosystems by changing how young, innovative companies are taxed and regulated. It applies to companies that meet specific criteria related to age, innovation, independence, and scalability, not just to anything that calls itself a startup on a pitch deck. If your company qualifies, the first major change hits corporate tax. Instead of paying the standard corporate tax rate, qualifying startups benefit from a reduced corporate tax rate for their early profitable years. This matters more than people think, because the first years of profitability are usually when cash is tight, reinvestment is critical, and every percentage point of tax hurts disproportionately. On top of that, the law improves loss carry-forward mechanics, which means early losses, which are almost guaranteed in real startups, become more valuable later. Losses are not just a bad memory. They are a tax asset that can offset future profits more effectively, which smooths the transition from burn to sustainability. Another overlooked benefit is administrative breathing room. The startup law extends deadlines and reduces pressure around certain tax payments during the earliest phase of a company's life. This is not glamorous, but it matters when founders are choosing between building product and fighting paperwork. Now let us talk about employee incentives, because this is where Spain made a very deliberate move. Startups live and die by talent, and Spain historically struggled to compete with countries that offer attractive stock option regimes. The startup law significantly improved the tax treatment of employee stock options, increasing the amount that can be received with favorable tax treatment and delaying taxation to more sensible moments. This changes hiring dynamics. Instead of being forced to pay higher cash salaries to compensate for weak equity incentives, startups can offer meaningful upside without immediately triggering punitive taxes for employees. This does not eliminate all complexity, but it finally makes equity a realistic tool instead of a theoretical one. For founders, this also matters psychologically. You are no longer punished immediately for granting equity to build a team. The tax system stops fighting the incentive structure that startups actually need to function. Now we get to the part investors care about, and the part most founders underappreciate when pitching Spain as a jurisdiction. The startup law improved tax incentives for investors who put money into qualifying startups. This includes higher deductions for investments and better treatment of gains under certain conditions. Why does this matter? Because investors price risk. If investing in a Spanish startup comes with tax friction, the valuation suffers or the money goes elsewhere. By improving investor-side incentives, Spain is not just helping founders directly, it is improving the funding environment they operate in. This also helps angel investors, not just large funds. Early-stage capital often comes from individuals, and giving them tax relief for backing innovation makes a real difference in how willing they are to write checks. Another subtle but important change is how Spain defines innovation under the startup law. It is not limited to deep tech or academic spin-offs. Software, digital platforms, data-driven models, and scalable service innovations can qualify, provided they meet the criteria around novelty and growth potential. This broad definition reflects how modern startups actually operate. Now let us be very clear about what the startup law does not do, because confusion here creates disappointment. It does not make Spain a zero-tax country. It does not remove compliance obligations. It does not automatically apply to every company that incorporates and says it is innovative. Qualification matters. Timing matters. Documentation matters. The law rewards companies that fit the framework and can demonstrate it, not companies that hope the label alone will protect them. This is also where coordination with the tax authority becomes important. The benefits of the startup law are applied through normal tax processes, filings, and assessments with the Agencia Tributaria. There is no magic approval that shields you from scrutiny. You still need clean accounting, proper filings, and consistency between what you claim and what you do. The biggest mistake founders make is treating the startup law as a personal tax strategy instead of a company strategy. It is not about optimizing your paycheck. It is about extending runway, attracting talent, and making your cap table more appealing to investors. The second biggest mistake is assuming it applies forever. Like all incentive regimes, it has a window. It is designed to support the early and growth phases, not to subsidize mature companies indefinitely. Planning around when benefits start and when they end is just as important as qualifying in the first place. If you compare this to the Beckham Law, the contrast becomes clear. The Beckham Law is a short-term personal incentive for specific individuals. The startup law is a structural change aimed at building companies and ecosystems. One helps you earn more personally, the other helps your company survive long enough to matter. Founders who understand this stop asking whether Spain is low tax and start asking whether Spain is supportive at the exact moment when startups are most fragile. For many profiles, the answer is yes, but only if you engage with the system intentionally. The startup law does not replace good business, good product, or good timing. But it does change the cost of failure and the reward for persistence, which is exactly what startup policy is supposed to do. If you are building a company in Spain, or considering Spain as a base, the real question is not whether you qualify for the Beckham Law personally, but whether your company qualifies for a framework that reduces friction when everything is hardest. Because personal tax perks come and go, but the companies that survive are the ones that align themselves early with the incentives that quietly support growth in the background, long after the headlines stop talking about them.